Overview of real estate syndication. Real estate syndication is an investment structure where multiple investors combine their financial resources and expertise to acquire large, income-producing properties. This model has gained significant popularity over recent decades, enabling individuals to participate in deals that would otherwise be financially or operationally out of reach. It effectively democratizes access to substantial real estate assets, such as apartment complexes or commercial office buildings. Syndication allows for the acquisition of properties that typically demand significant capital and sophisticated management. By pooling funds, investors can access larger, more lucrative assets, benefiting from economies of scale and professional management. This collaborative approach mitigates the challenges individual investors face when targeting high-value real estate. Syndication example and benefits. Consider a Class B multifamily property in Austin, Texas, valued at $10 million. A solo investor would face immense capital outlay and the burden of managing tenant issues, maintenance, and complex legalities. Through syndication, an experienced sponsor could raise $3 million in equity from 20 passive investors, each contributing $150,000, while securing a $7 million commercial real estate loan. This collective model allows all participants to profit based on their contribution, sharing both the risks and rewards. It provides passive investors with exposure to lucrative markets, while experienced sponsors handle day-to-day operations, acquisitions, and asset management. This structure has made large-scale real estate accessible to a wider range of investors. Key concepts: general and limited partners. The core concept of real estate syndication is collaboration, forming a partnership between investors to acquire significant real estate assets. These partnerships typically involve two main groups: general partners, GPs, and limited partners, LPs. GPs are also known as syndicators or sponsors, while LPs are the passive investors. The general partner is responsible for identifying and sourcing the deal, performing due diligence, managing the property, and making executive decisions throughout the investment lifecycle. In contrast, limited partners primarily provide the majority of the equity capital, relying on the GP's expertise for management and operations. LPs share in the profits, but have limited involvement in daily management. Syndication structure and incentives. Real estate syndications are typically structured using legally established entities like limited liability companies, LLCs, or limited partnerships, LPs, to clearly define ownership. For example, in a $2 million equity raise, a GP might contribute $200,000 for a 20% ownership stake, while LPs provide $1.8 million for the remaining 80%. This structure ensures clear delineation of roles and responsibilities. Income from rents, refinances, or property sales is distributed based on this ownership breakdown, though GPs often receive additional incentives. These can include acquisition fees, management fees, and a share of profits above a preferred return threshold, typically ranging from 6% to 10% annually. This preferred return structure aligns incentives, ensuring GPs are motivated to maximize property performance for all investors. Historical evolution of syndication. Real estate syndication is not a recent innovation. Its origins can be traced back to the early 20th century, when investors first began pooling capital for large-scale developments. However, the modern structure we recognize today truly began to form in the mid-20th century. This period saw the enactment of crucial legislation, specifically the Securities Act of 1933 and the Securities Exchange Act of 1934. These foundational laws were instrumental in establishing the legal framework for fundraising and investor protections, which helped legitimize syndication as a viable investment vehicle. Before these regulations, many early syndications were unregulated, leading to potential abuses and investor losses. the laws provided a much-needed structure for the burgeoning industry. Modern syndication and crowdfunding. The 1960s and 1970s witnessed a surge in syndication activity, partly due to the rise of real estate investment trusts (REITs). However, this growth also highlighted the need for stricter oversight, leading the U.S. Securities and Exchange Commission (SEC) to enforce greater compliance, particularly with the private placement exemption, Regulation D, becoming popular in the 1980s. This period marked a significant step towards investor protection. With the advent of technology and crowdfunding platforms in the 2010s, real estate syndication underwent another major evolution. New online platforms broadened access to private real estate deals, allowing both accredited and non-accredited investors to participate with smaller capital contributions, sometimes as low as $10,000. This shift further democratized real estate investing, exemplified by platforms like Fundrise, which manages billions in assets today. Syndicator's core role. The syndicator, also known as the general partner or sponsor, is the central figure in any real estate syndication deal. This individual or team is responsible for identifying promising investment opportunities, structuring the deal, and actively managing the group investment throughout its life cycle. They are the mastermind who brings the entire transaction to fruition. A syndicator wears many hats, acting as a deal maker, negotiator, project manager, marketer, and often a capital raiser. Their expertise in financial analysis, negotiation, leadership, and communication is crucial for success. A well-prepared syndicator not only understands real estate, but also excels at managing people, projects, and investor expectations, ensuring a smooth and profitable venture. Syndicator responsibilities life cycle. A syndicator's responsibilities span the entire investment life cycle, starting long before a property is acquired. During the pre-acquisition phase, they source and underwrite deals, conduct market analysis, build broker relationships, negotiate purchase agreements, and prepare all necessary legal and SEC-compliant documents. This meticulous preparation is foundational to a successful syndication. Post-acquisition, the syndicator transitions into an asset manager, overseeing property operations, executing business plans, and managing expenses. Investor relations are paramount, requiring regular, transparent updates on performance, renovations, and market conditions. Finally, at the exit phase, the syndicator manages the property sale or refinance, distributing profits according to the waterfall structure and legally closing the syndication. This continuous oversight builds investor trust and ensures long-term success. Property management oversight. Effective property management is a cornerstone of successful syndicated real estate investments. The property manager, whether in-house or a third-party firm, is responsible for the day-to-day operations of the asset. This includes critical tasks such as rent collection, tenant management, and ensuring the property is well maintained. Proper management directly influences cash flow, tenant satisfaction, and ultimately, investor returns. Choosing the right property manager is a crucial decision. Syndicators should seek companies with a proven track record in managing similar property types within the specific market. A good property manager possesses a deep understanding of local market dynamics, including rental rates, tenant demographics, and regulatory requirements. Their expertise ensures the business plan is executed correctly, safeguarding the investment. Maximizing cash flow strategies. Maximizing cash flow is a primary objective for any real estate syndication, and effective property management is key to achieving this. One crucial strategy is rent optimization, where the property manager regularly reviews market conditions and adjusts rents to align with current rates, implementing increases upon lease renewals. Offering incentives like a month of free rent for long-term leases can also attract and retain quality tenants. Another vital strategy is tenant retention, which is often more cost-effective than constantly seeking new tenants. Property managers can foster long-term relationships by providing exceptional customer service, ensuring timely maintenance and promptly resolving tenant issues. Additionally, reducing operating expenses through renegotiating service contracts and implementing energy-saving measures directly boosts net operating income. Strategic capital improvements, such as upgrading kitchens or common areas, can also significantly enhance property value and rental income, attracting higher quality tenants. Joint ventures and co-investing. As syndicators gain experience, they often explore advanced strategies like joint ventures, JVs, and co-investing to scale their operations. Joint ventures are strategic partnerships where two or more parties pool resources for a shared project, allowing syndicators to expand without overextending their own capital or operational capacity. This is particularly useful for tackling larger or more complex deals. For instance, a syndicator specializing in multifamily properties might form a JV with a partner experienced in commercial redevelopment to acquire a mixed-use property in a gentrifying urban area. This collaboration allows them to access a more complex asset and share both the risk and reward. Co-investing, a variation where an investor contributes a large share of capital for equity and some control, also helps secure capital quickly, but requires clear legal agreements to prevent misalignment of goals. Building a syndication business. Scaling a syndication effort into a robust business requires more than just pursuing larger deals. It involves building a recognizable brand, developing an efficient operational model, and assembling a trusted team. A strong brand communicates trust, expertise, and professionalism, encompassing a name, logo, website, and investor-facing platforms. This brand should reflect the syndicator's values, whether it's conservative capital preservation or aggressive value-add growth. Effective business documentation, including repeatable pitch decks, PPM templates, and due diligence checklists, is crucial for streamlining operations and scaling efficiently. Building a strong network of partners, brokers, and investors is also fundamental. Successful syndicators nurture relationships through transparency, educational content, and exceptional performance, often leveraging CRMs and investor portals to manage these connections effectively. Consistent communication and execution with brokers, lenders, and property managers are vital for continuous deal flow. Real estate market fundamentals. To truly understand real estate syndications, one must first grasp the fundamental principles driving the real estate market. At its core, the market operates on supply and demand. When demand is high and supply is low, prices rise, and vice versa. However, real estate is unique due to its complexity, long-term investment cycles, and reliance on hyper-local dynamics. A thriving city block can exist next to an area with declining values, underscoring the importance of granular market analysis. Key forces influencing real estate pricing include demographic shifts, job growth, infrastructure development, school quality, access to transportation, and government policy. For example, a 1% increase in population often correlates with a 1.5% increase in housing demand. A syndicator who understands these dynamics can anticipate market movements, identify emerging areas, and maximize returns. Historical data analysis is also crucial for understanding past cycles of growth, stability, and decline, allowing for better positioning of properties within a market. Types of real estate assets. The world of real estate is diverse, categorized into several distinct asset types, each with its own market drivers, investor expectations, and risk profiles. Understanding these types, residential, commercial, industrial, agricultural, mixed use, and special purpose, is essential for syndicators. Residential real estate, including multifamily apartment buildings, is heavily influenced by population growth and employment trends, often considered stable due to steady rental demand. Multifamily properties are particularly attractive for syndicators due to economies of scale and consistent cash flow. Commercial real estate, such as office buildings and retail centers, is driven by business activity and local economic health. For example, the rise of remote work significantly impacted office demand, highlighting the need for dynamic underwriting. Industrial properties, including warehouses and distribution centers, have seen explosive growth due to e-commerce and supply chain changes. Special-purpose real estate, like hotels or self-storage, demands niche knowledge and often involves long-term leases. Syndicators must choose asset classes that align with their expertise, investor appetite, and market conditions. Market cycles: growth, stability, decline. Real estate markets, like all economic systems, operate in cycles typically categorized as growth, stability, and decline. Understanding these cycles is critical for timing investments, especially in syndication, where long-term planning is essential. A well-timed acquisition can significantly enhance returns, while entering at the wrong stage can expose investors to unnecessary risk. For instance, buying into an emerging market during a growth phase can yield strong returns, as seen in cities like Austin, Texas, and Raleigh, North Carolina, which have experienced prolonged growth due to tech migration and demographic shifts. The growth phase is characterized by increased employment, rising housing demand, new construction, and rent appreciation. Stability, or the plateau phase, follows growth, with prices leveling off and rent increases stabilizing, often a lower risk periods the cash flow-focused investments. The decline or contraction phase involves job losses, reduced demand, and falling property values, which, while risky, can offer tremendous opportunities for seasoned syndicators to acquire distressed properties at favorable terms. Wise syndicators learn to spot the signs of each phase, such as a slowdown in new building permits signaling the end of a growth phase, to align acquisition, financing, and exit strategies effectively. Importance of location in syndications. The adage location, location, location is a cardinal rule in real estate, and in syndications, it plays an even more vital role. Location directly impacts all key investment metrics, including occupancy, rent growth, appreciation, tenant quality, and exit strategy. Real estate is an immovable asset, and its performance is profoundly influenced by the characteristics of its immediate surroundings. A multifamily property in a growing suburb with good schools and public transit will almost always outperform a similar property in a declining area. Syndicators must meticulously analyze neighborhood statistics, employment sectors, zoning regulations, and future infrastructure plans. An effective strategy is the path of progress approach, targeting neighborhoods adjacent to thriving areas that haven't yet seen full-scale development. Investing ahead of the curve allows for significant asset appreciation once the market catches on, as exemplified by gentrification in cities like Atlanta and Dallas. Proximity to employment centers, universities, and hospitals also ensures strong rental demand and tenant retention, making location foundational to syndication success. Conducting market research. Effective market research is the cornerstone of every successful real estate syndication, requiring a detailed, data-driven approach before committing investor capital. This process goes beyond simply scanning listings. It involves a deep dive into demographic trends, economic indicators, governmental policies, and real estate performance metrics. The goal is to uncover markets offering long-term stability, rent growth potential, and low vacancy risk. Research typically begins with a macro to micro approach. At the macro level, syndicators analyze nationwide trends like job migration patterns, population shifts, and interest rate changes. For example, the shift of tech jobs from California to cities like Austin, Nashville, and Miami creates significant ripple effects in local housing demand. Once a promising region is identified, research narrows to the metro, submarket, and neighborhood levels, examining factors such as average rent prices, median household income, housing supply and demand, and planned developments. The best syndicators understand local nuances, zoning regulations, and municipal plans, using tools like CoStar and Census.gov to guide decisions. Identifying high-potential markets. Identifying high-potential markets is both an art and a science, a skill that distinguishes successful syndicators. A high-potential market is typically in the early or mid-stages of a growth cycle, where property values and rental rates are projected to increase due to demand outpacing supply. These markets exhibit several key indicators, including robust population growth, strong job creation, significant infrastructure investment, new business development, and favorable landlord laws. However, not all growth is sustainable, necessitating deep analysis beyond surface-level indicators. One of the most critical indicators is net migration, as people moving into an area in droves directly drives housing demand and pushes rents higher. Cities like Boise, Idaho, and Tampa, Florida, have experienced significant population booms due to affordability and lifestyle appeal. Job growth, particularly in stable sectors like tech, healthcare, and education, is another essential metric. Huntsville, Alabama, for example, has emerged as a real estate hotspot due to its tech and defense sector job creation. Additionally, new airport terminals, light rail systems, or freeway expansions can open new areas to development and increase property desirability. Savvy syndicators balance current indicators with forward-looking risks, using tools like MeshVisor to rank cities based on projected rental yields and appreciation. Tools for market analysis. In today's data-driven world, a plethora of market analysis tools are available to real estate syndicators, but knowing which ones to use and how to interpret their data is crucial. Market analysis blends macroeconomic indicators with property-specific data to create a comprehensive picture of investment viability. Key resources help syndicators analyze demographics, housing trends, income levels, employment data, and local real estate performance, all of which influence property profitability. One foundational tool is CoStar, a commercial real estate analytics platform providing data on sales comps, lease comps, market rents, vacancy rates, and construction pipelines. Yardi Matrix offers detailed data on multifamily rent trends and unit-level amenities. For residential insights, Zillow's research portal and Redfin Data Center provide free access to pricing trends. Government sources like the U.S. Census Bureau and Bureau of Labor Statistics, BLS, offer employment and housing data. Platforms like MeshVisor and Roofstock assist in modeling cash flow and returns. Beyond digital tools, local real estate professionals, brokers, lenders, and property managers provide invaluable insights into emerging trends before they appear in datasets. Leveraging these reliable, up-to-date tools is a best practice that differentiates successful syndicators. Key Performance Indicators, KPIs. Key performance indicators serve as the compass for real estate syndicators, guiding investment decisions by providing measurable metrics for market strength, asset performance, and long-term viability. Without KPIs, decisions would be made blindly. Some KPIs evaluate the broader market, while others focus on a specific deal's profitability. Understanding both categories is essential for informed investment strategies. At the market level, population growth and job growth rate are top-line KPIs, signaling increasing housing demand and affordability. Median household income versus average rent helps determine market sustainability. Occupancy and vacancy rates are crucial for demand and tenant retention. For individual properties, net operating income, NOI, measures profitability after expenses, while the cap rate, NOI, divided by property value, compares properties or markets. Deal-specific KPIs include cash-on-cash return, internal rate of return, IRR, and equity multiple, which measure investor returns over time. Tracking permit activity also provides insight into future supply. Each KPI tells a piece of the story, and syndicators must interpret them in context, understanding their interplay to make actionable insights. Once a syndication is deemed to involve securities, it becomes subject to federal securities laws, primarily enforced by the Securities and Exchange Commission, SEC. This means the offering must either be registered with the SEC or qualify for an exemption. Compliance is not optional. The Securities Act of 1933 governs issuance, and the Securities Exchange Act of 1934 covers ongoing reporting. Failure to comply can lead to severe consequences, including fines, investor money return, and even criminal charges. Understanding these laws is foundational for legally sound syndication. SEC and state regulators. The Securities and Exchange Commission, SEC, plays a critical oversight role in real estate syndications, acting as the referee in the capital raising game. While many syndicators don't register their offerings with the SEC, the Commission still monitors compliance with exemptions and investigates violations. The SEC's primary concerns include ensuring investors are provided with truthful information, that offering documents fairly disclose risks, and that syndicators follow proper exemption channels. They aim to protect investors by ensuring transparency and informed decision-making. State securities regulators, often called blue sky regulators, also play a role. While federal law often preempts state law for certain exempt offerings under Regulation D, many states still require notice filings or fees. For example, if a Regulation D 506B syndication has investors in 5 different states, the syndicator may need to file forms and pay fees in each of those states within 15 days of the first sale. Working closely with a securities attorney is essential to ensure timely filings, compliance with state-specific requirements, and proper offering structure to minimize risk and avoid penalties. Regulation D Exemptions Overview. Under Regulation D of the Securities Act of 1933, there are 2 most commonly used exemptions for real estate syndications: Rule 506B and Rule 506C. These rules allow syndicators to raise capital without the costly and time-consuming process of full SEC registration. The choice between 506B and 506C significantly impacts how an offering can be marketed and who can invest, making it a critical strategic decision for any syndicator. Each rule has distinct pros and cons regarding general solicitation, investor accreditation, and verification requirements. Understanding these differences is paramount for legal compliance and successful capital raising. For instance, Rule 506B allows for a broader pool of investors, including non-accredited individuals, but restricts public advertising. Conversely, Rule 506C permits public advertising but limits investment to only verified accredited investors. Syndicators must carefully weigh these factors against their target investor base and marketing strategy. Rule 506B details. Rule 506B allows syndicators to raise an unlimited amount of funds from an unlimited number of accredited investors and up to 35 non-accredited but sophisticated investors. A sophisticated investor is someone who, alone or with a purchaser representative, has sufficient knowledge and experience in financial and business matters to evaluate the merits and risks of the prospective investment. This flexibility in investor types makes 506B a popular choice for syndicators with existing networks. However, a key restriction of Rule 506B is the prohibition of general solicitation or advertising. This means syndicators cannot publicly promote the offering through social media, podcasts, or public conferences. Instead, they must have a pre-existing substantive relationship with each investor before presenting the opportunity. This substantive relationship generally implies understanding the investor's financial background and investment experience, ensuring they are suitable for the offering. While it limits marketing reach, it allows for a broader mix of investor sophistication. Rule 506C details. In contrast to Rule 506B, Rule 506C allows for general solicitation and advertising, meaning syndicators can publicly promote their offerings through various channels like social media campaigns, webinars, podcasts, and email marketing. This opens up significant marketing possibilities, enabling syndicators to reach a much broader audience of potential investors. This rule was a game changer for real estate crowdfunding, allowing platforms to openly advertise deals. However, the trade-off for this marketing freedom is a stricter requirement. Syndicators can only accept verified accredited investors. This means investors must prove their financial standing through third-party verification, such as a CPA letter, tax returns, or brokerage statements. Self-certification is not sufficient. This added verification requirement increases compliance work, but ensures that all investors meet the SEC's definition of an accredited investor, presumed to be financially sophisticated and capable of bearing investment risks. This rule is particularly favored by larger syndication firms with robust marketing and compliance infrastructures. Legal structure, LLCs and LPs. The legal structure chosen for a real estate syndication profoundly influences tax obligations, liability exposure, and control dynamics. The two most common structures are limited liability companies, LLCs, and limited partnerships, LPs. In both, participants typically fall into two categories: the general partner, GP, or syndicator, and the limited partners, LPs, or passive investors. The choice of structure is a foundational decision that impacts the entire deal. In an LLC structure, the syndicator usually forms a manager-managed LLC, where the GP team oversees operations and investors hold membership units. A key benefit of LLCs is limited liability protection for both managers and members, meaning investors are typically only at risk of losing their initial investment, not personally liable for project debts. In a limited partnership, a designated general partner assumes all management responsibilities and unlimited liability, while LPs contribute capital with limited liability, provided they do not participate in management. LLCs are generally preferred today due to their greater flexibility.